Hey everyone, it's Joe here. I just want to post another investing lesson today. So, what I want to talk about in this one is how lower prices today in the stock market can equate to higher returns tomorrow, or in the future at least. So, when stocks are falling sharply, it's only natural to feel nervous, obviously, and insecure about your investments. It's never nice. However, as long as you have time on your side, and you'll hear me go on about this a lot if you're new to the group, corrections and bear markets are actually opportunities for higher returns in companies with strong fundamentals, and this is something you need to remember. So I don't use price targets in my work. You'll see that I have like buy under prices in the Savvy Portfolio spreadsheet tracker. That's not a price target as such. It's just a price that I'm happy to pay for that stock. Um, Valuation targets are different. They depend on your estimates for revenue, cash flows, and valuation multiples in the future. Financial variables can't be predicted though with any degree of precision, especially for, high octane growth stocks with plenty of optionalities and operating in intensely dynamic industries. If sales and cash flows are impossible to forecast with precision, the valuation multiples, which depend on market sentiment to a good degree, are therefore a lost cause. Nevertheless, I do assess valuations for companies in the portfolio. It's just that I view these valuations as probabilistic thought exercise, a probabilistic thought exercise with a huge margin of error as opposed to a precise price target for a stock that I genuinely believe is going to be achieved. You know what I mean? It's never how it works. Those clarifications being made, let's take a look at some quick numbers for Mercado Libre. So ticker symbol MELI, MELI. This is a stock that I bought recently. So yeah, let's take a look at it in order to quantify the impact of a lower stock price on future returns. So Mercado Libre is now trading at a valuation level that is lower than the valuation it had before COVID. So keep in mind that the rest of the market is far more expensive than pre-COVID, and also that Mercado Libre has consolidated its leadership position in the industry as it secured basically several years of high growth, all compressed into a few quarters during lockdowns. So the average price estimate among the Wall Street analysts following the stock is $2,094 for next year. I don't put much weight on Wall Street estimates, but this is a reasonable number. If you ask me, if you assume a price to sales ratio of say around 10 to 13 on 10 to $11 billion worth of revenue. But note that there is a wide range of estimates in revenue numbers because of the impact of currency fluctuations, and that makes it hard to quantify. This versus a current price of nearly $1,300, that is, that's an upside potential of 60% in the short term. But that is just the short term view of the upside of Mealy or Mercado Libre. So let's do some, ridiculously basic maths for Mercado Libre, say in like 2026. So in 5 years, we can assume a revenue range between 27 and $33 billion, with 54 million in shares outstanding, which would assume some additional dilution, so more stocks becoming available in the market, which is normal for these kind of companies. So we're not making forecasts here, we're just playing with assumptions. So the average price to sales ratio in the past 5 years is 14. So we should assume a healthy discount as the company matures, and also because we need to err on the side of caution. So let's use 7 and 10 as the target price to sales ratio for Mercado Libre in 2026. So here are some price targets based on 27 billion, 30 billion, and 33 billion in revenue for 2026, and a price to sales ratio of 7 and 10 for Mercado Libre in 5 years. The average among these values is 4,722. Let's apply a 10% haircut just in case we get a ridiculously imprecise price target of say $4,250. The aggressive price target is 6,111, which is based on taking the highest sales estimate among the Wall Street analysts that follow the stock and applying it to a price to sales ratio of 10. Again, this is rather aggressive, but not unreasonable by any means, considering the company's track record and growth opportunities anyway. When Mercado Libre stock was trading at highs of around $2,000 per share, the moderate price target was providing a total return of 112% for 2026, meaning an annual return of 16% in 5 years. It's not bad at all, but not outstanding. Now at around $1,300 per share, which is where it sits around now, the upside potential is hugely more impressive. We make a total return of 227%, meaning 27% per year over 5 years. Let's look at the more aggressive price estimate for 2026, just for fun. In that scenario, the stock was priced for a 206% return at $2,000. At at current prices and using more optimistic revenue assumptions, Mercado Libre is now priced to a return of 370% or 36% annually in the next 5 years. Aggressive? Yes. Impossible? I don't think so. The lower the price today, the bigger the future returns if the company's fundamentals remain intact. In some cases, there could be good reasons for why the stock is down. Perhaps the fundamentals are deteriorating and we need to be extremely careful with the stock. However, and this is important, what we have experienced recently is a broad sell-off across mid and small high growth companies. This is about market sentiment and not about fundamentals, so it can be considered a source of opportunity for long-term investors. What if the market has another panic attack in 2026 and valuations are depressed again for whatever reason? If the stock is cheap once again and you have more time ahead of you, then you can buy more Mercado Libre stock and wait. On the other hand, if your time horizon is shrinking, then it is better to be reducing risk exposure as time passes. For example, if you have 5 years until retirement and if you have 5 years until retirement, you can have considerable exposure to growth stocks now, but you should probably consider reducing your exposure as time passes by and your time horizon is shrinking. I would always be looking to reduce this exposure to a larger degree when prices are higher. For example, reducing more risk in 2020 when valuations were elevated and being more patient with risk exposure in 2021 when valuations are obviously much more attractive. Back to Mercado Libre, even 5 years may not be, a big enough time frame. The company is becoming something like the Amazon and Square of Latin America due to its leading presence in e-commerce and fintech. Other markets such as credit services, advertising, and small business software are still almost untapped opportunities for Mercado Libre. Speaking of which, the company has recently announced that it will be offering crypto trading in Brazil, opening the doors to exciting opportunities going forward. It is interesting to note that revenue estimates for Mercado Libre have been consistently increasing over time as the company typically exceeds expectations. The chart below, or shown on the screen now, shows the evolution of revenue estimates for 2021, which have been increasing before lockdowns, during lockdowns, and after lockdowns ended. Now, let's talk about staying power and long-term compounding. So, having staying power in order to compound returns over the long term is perhaps the most important success driver in the market, and it is widely underappreciated. I talk about this often, and again, you'll hear this from me if you're new here. But I was still surprised by the following question, which comes from the book, if you've read it, One Grain of Rice, A Mathematical Folktale. This is a story about a girl who outsmarts a greedy king by leveraging her mathematical skills. This king was extremely greedy and he was keeping all the rice for himself. This would make him a very great politician these days, but that aside, the girl does a good deed and she is allowed by the king to ask for a favour in return. The girl has a simple request. All she wants is just one single grain of rice on the first day. Then, for the following 30 days, she would receive double the amount of rice she received on the previous day. So it is 1 grain of rice, 2 grains of rice, 4 grains of rice, 8 grains of rice, and so forth. Just by guessing how, without using a calculator, how many grains of rice do you think the girl received on 30 days? And pick a high number. You're probably still going to underestimate it. So spoiler alert, it's 1,073,741,823 grains of rice over 30 days, cumulative, which is insane. There are two very important lessons from this story. One is that we often, I would say always, underestimate the impact of compounding. Generating gains on prior gains can be extremely powerful, and we often lose sight of how much wealth can be created in this way over the long term. Most of the really big gains came later in the time period, so it's critical in this equation. And this chart shows how the cumulative number explodes higher after 25 days of a total of 30 days. This brings to mind an example that we have discussed in the past, but it's very relevant once again in this conversation, and that's the real reason why Warren Buffett is so massively wealthy. It's because of time, not because of his stock picking skills alone, although they were very good, but not alone. From the Psychology of Money, there's this quote. So as I write this, Warren Buffett's net worth is 84.5 billion. Of that, 84.2 billion was accumulated after his 50th birthday. 81.5 billion came after he qualified for Social Security in his mid-60s. The real reason why Warren Buffett is so spectacularly rich is not that he made high returns, but that he maximized the power of time. Buffett's returns are in the neighborhood of around 22% annually, which is obviously outstanding, but the real game changer in this equation is time. Warren Buffett amassed an $84.5 billion fortune because he started investing when he was 10 years old. When he was 30, Buffett already had over $1 million in net worth, and he never stopped investing to this day. What if Warren Buffett then had obtained those same annual returns, but he had a smaller time frame to compound his gains? So let's assume Buffett started investing in his 30s with 25k in net worth, and he retired from the markets when he turned 60. This would be, more typical investor in terms of time horizon. The real Warren Buffett, with an extremely long-term time horizon, had 84.5 billion by the time of this calculation. The alternative version of Buffett, the normal guy, you and I, who started investing at 30 and retired at 60, would have 11.9 million. This is 99.9% less than his actual net worth. The impact of long-term compounding is so massively big that it is hard to comprehend. We know conceptually how important this is, but we truly lose sight of the magnitude that time has on wealth creation. That brings this video to a close. As always, feel free to ask me any questions if you have any. I'll be back again soon with another lesson and obviously more updates as the weeks come by. Have a great day, everyone.